Good evening, ladies and gentlemen. Welcome to my very first YouTube broadcast. I've set up a channel today. It's Wednesday the 2nd of April. And the reason I've done that really is to keep you all informed of what's going on in the world. Well, in the investment world anyway. I'm sure you listen to the news 24/7 these days. Hope you're all safe and well. We're all in this together. I've stayed in or been locked in for at least 13 days, 14 days now. I've managed to jet wash all the steps, the back garden, front, painted 2 bedrooms. And luckily for me, I'm what you call a non-essential worker, but I've got a digital platform to work with, so I can quite safely work from home. What this evening is going to be about really is just going to give you an update of where we are and what's happened. ISA season is coming up as well, and I'll give you the reasons, some good reasons why it's a good time to invest. A long time, and I've been doing this since 1992. Would have seen lots of things like this over the years, but I say lots of things like this, nothing like this really, because we've had Black Monday, Black Wednesday, the exchange rate mechanism collapsing, interest rates going through the roof that day, 15% I think mortgages were then. Inflation was running at 12%. We've had the 1999 dot-com bubble burst. We've had September the 11th, 2001. We've had Donald Trump recently, last quarter of 2018, having a spat with China over trade. Monetary policy, this is to do with the virus and how that affects the economy, the affects shares and other assets as well, which I'll come on to later. And basically, we can't compare this to any event in the past because it's unprecedented. But what we do know of all those events I've mentioned, markets do come back. They don't go down forever, conversely, they don't go up forever. I think the worst one was the Great Depression back in the late 1920s, early 1930s, where I think the market pretty much lost nearly all of its growth. I think 90% is wiped out. We've never returned to that since, thankfully. We've now got mechanisms in place anyway for that. But I think the beauty of what I do and what True Potential do is not invest directly in shares or in stock markets called indices. Most of our funds, if not all of them, diversify. And what I mean by that is they'll invest in all different assets, shares for example, but not just a handful of shares. There'll be thousands and thousands of shares traded globally by at least 8 or 9 different fund managers, very bespoke fund managers. You'll have in there commodities like gold, you'll have property in there, you'll have good old cash in there, and as you would have seen last week, the Bank of England lowered the rate to its historical low of 0.10, a tenth of 1% on your money. So not a good time for savers. So here we are, April the 2nd. I think over the last month we've seen unprecedented drops in all world stock markets. And all of us have been affected by that, including me. As you know, I'm with you in this. Most, if not all, my money is in the same portfolios as you. But those who do know me also know that my portfolios are quite aggressive, which means it's heavily weighted towards stocks and not much in the way of bonds and other safe-ish, if you like, assets in there, like government bonds, cash, fixed income assets, derivatives, etc., gold. So yes, I lost on paper quite a lot of money. On the 23rd of January, I think my portfolio was at its highest, and also your portfolios were at their highest. And then the coronavirus kicked in. So yes, I think personally I lost myself about 27%. I think the market's lost between 25 and 30 on average. But it was a paper loss at the end of the day. I got time my side, and if anybody was with me at the beginning of 2009 after the financial crisis, they would have seen all their money pretty much recovered, and you know who you are. There's quite a few of you out there who were with me then. So it didn't take that long. It doesn't take long to collapse, as you've seen in these unprecedented times. But it doesn't take that long to come back. And when I mean that long, it's not going to be a few weeks or months. It's going to be at least a year to get back to the levels that we were. Now is an opportunity. Although some people may play on emotion, I think that may be daft. How is that an opportunity? You could lose even more. But we've lost between 20 and 25% on average in certain funds. Don't think it's going to go any lower, and what I mean by that, it's not going to do another 20 or 25%. Now, if you compare that to a sale, let's pick one who's always got sales, DFS. If that settee you were after, or bedroom suite you were after, was, let's say, £1,000, and now the sale is £500, are you going to buy it? Or are you going to wait till it goes back to £1,000 before you buy? Now, I know that's a poor analogy, but some of these stocks out there, with these big players in the market, companies will still continue to trade anyway. Yes, we may lose some of the minor ones, but you are buying, or our fund manager now are buying into stock very cheaply with new money. And this is an opportunity for you as well. ISA season is coming up very shortly. In fact, it's with us. April the 5th is the deadline to utilise this year's ISA. You have £20,000 allowance. You don't have to use the full £20,000 if you haven't got that kind of money, but if you've got money sitting dead in bank accounts, now that's a good time to invest money into your portfolios. I can't think of a better time. Can you? Unless you can call the bottom of the market, but we certainly are wallowing around the bottom at the minute. It's up 4% one day, down 4% the following day, up 4% one day, down 3% the next. So I think we've reached the bottom. Who am I to say? I'm got a crystal ball, but we've had the big loss, your 20 to 25% taken out of the markets anyway. So real good time to invest. Now you can do that through your sites, your client sites. This is why it's good to be in digital. You can go onto your client site. I'll show you in a second.
Welcome back to the Investor Academy series, which shows you how to get the most from your investments. In this video, we'll explain how to top up your investments from as little as £1 using Impulse Save on our mobile app. Once you've logged in, click Top Up in the bottom right of your screen. You'll then be asked to choose which account you wish to Impulse Save to. You will then need to enter how much you wish to Impulse Save. You can either type in how much you would like to invest, or for speed and ease, choose £10, £50 or £100.
You will also see an option to close your gap to goal. This lets you know if you have fallen behind your goal and calculates the amount you need to top up at that time to get back on track. Finally, you'll see an option to use pension allowance or use ISA allowance, depending on the type of account. This calculates your remaining allowance for the current tax year so that you can make the most of it in just a few taps.
Once you've selected how much you want to Impulse Save, press Continue and you will be taken to the next step, which is choosing the payment card you wish to use. If you haven't already added a card to your account, this is where you do so. After selecting Add a Card, you will be asked to fill in your card details. Once this is done, press Continue. If you already have a card associated to your account, you can select it and press Continue. Once you've chosen your payment method, you'll need to review your choices. If you're happy, click make impulse save. You'll then see confirmation of your impulse save, which will show as pending in your account until we receive the money from your bank so we can invest it in your portfolio. That's how easy it is to impulse save using your mobile app. Thank you for watching.
As you can see from that YouTube video with our head office, what an impulse save does with its speed, it's reliable, but there's also a word called pound cost averaging. Now what that means is each time you put money in, you're buying the unit price, which is the average of all the assets within the fund. They come up with one price. So let's say it was £1 and you put £100 in, you'll buy 100 units. If that unit price then goes to £2 a unit, you then double your money. Now it's not going to be that quick, but I'm just showing you that for an example. If the following time you put money in, the unit was 50 pence, and you put £100 in, well obviously then you're going to buy double the units for the same £100. So once that 50 pence then goes back to £1 a unit, then you doubled your money that way. So what you've lost on the first bit, you've gained on the next bit. That's pound cost averaging for you. There's also on our site transfers of ISAs. So if you've got a cash ISA or a stocks and shares ISA or another provider, you can go on the site and click on add transfer. And of course you've got a very favourable entry point if it's in a cash ISA, because you are, as I said earlier, buying quite low, which is fantastic. And also you can consolidate excuse me, your investments on the one platform. I'll be running meetings very soon on Zoom. They've also got GoToMeeting, which is the ones I do when I have webinars with our head office. But I've chosen Zoom because it's free. But I can send links to clients' emails, and you can just join me then on a webinar, and we can ask questions. So it's a very good tool. You can also follow True Potential on any of these social media, because I know our executives and the higher staff members or senior members, they sit around the table once a week and do a podcast, which is there. That's David Harrison, who is the owner of TP. Very modest guy. Again, most of his money is in his own platform. What a fantastic down-to-earth guy, and he's a Geordie. You've also got daily morning updates as well on YouTube. So if you subscribe to the YouTube channel, that's Chris Leyland there, Chief Investment Officer. They are very informative as well. And the theme of the webinar the other day was controlling your emotions. Now I've been here many times, but for those of you clients who haven't been in this situation before, it's quite easy to run away with what's on the media. Yes, they have to sell doom and gloom. They never tell you billions of pounds added to pension funds when things are going up. It's always billions wiped out of pension funds. They never tell you the upsides or the good stories. But I can understand, because this is for people who've just come into this, into the investment world. The immediate reaction is, am I going to lose all my money? Well, I wouldn't say it's impossible, because the world has to go bankrupt in order to do that. And what I mean by that, because it's diversified, stocks, bonds, property, cash, commodities, lots more than that, derivatives. In order for you to lose your money to nil, then all the governments that produce bonds in the world, the government's got to go bust. All the companies that trade in shares, they've got to go bust. All the commodities have got to go to nil. But all on the same day, next Wednesday, 2 p.m. in the afternoon, all of those goes bust. Then you lose your money to nil. But can you lose the value of your money? Well, of course you can. That's, if the markets went up forever, you may as well close banks and building societies, because we'd all be in there. So sometimes we have these, what they call corrections. This isn't a correction, by the way. Corrections are caused by overheating In other words, very much like the panic buyers, people will start buying stocks all the time and overheat and lend out money for loans, and it has to come back, it has to peg back now and again. But this is different. This is because of a virus. And on that, very interesting slide. I don't know if you can see that. But this looks at the US stock market's 10 worst days and their rebounds. On the 15th of the 10th, 2008, the global financial crisis, the markets lost 9%. But after a year, it bounced back 24%. You would have made after the day after that, a year later after that fell. And had you held on to that then for a further 5 years, 109%. 2 months later, global financial crisis. This is full of global financial crisis. Look on these different dates from the 10th, the September, October, and December. Years of the falls. Here's the returns a year later, and here's the return after 5 years. The Asian economic crisis, nearly 7% in one day. But again 23% after a year. Russian defaults on loans, -6, nearly 30%. Global financial crisis in November, 6.7, made 48%, and so on. So it's not about the timing, but the time in there. But this goes to show really, if you went in on that day, there's the returns. But this is just the US stock market, so this is investing in a stock market. That's without bonds and cash and property, fixed income assets, derivatives, commodities, etc. That's 10 days, 24th of February to the 3rd of March, the Dow Jones had record sizable losses, but it then registered two of the largest daily point gains in history. This has continued to a further record rise. But careful, there is still some volatility left, but nothing on the scale of the recent activity. As I said, the biggest drops, we think anyway, or shall I say I think has already happened. So we're now wallowing around the bottom of the basin, if you like. So we will get there. So the markets were driven by COVID-19. Coincidentally, it was also the timing of that with oil between Russia and the Middle East, OPEC, fighting over the price of oil and the output. And of course there's been the volatility as well. So they've been the three drivers, really, what's happened over the last month or so. So what have our managers done? They've been looking at more longer term asset allocation. That's going to be with us a long time, as opposed to short term. Let's put money there where we can make a quick win on it. No, they don't do that. They're in it for the long term. Bonds, gold, oil, emerging market and equities, and alternative assets. So they look at these daily, and they get round the table and they decide where the value is. Recent changes, they've reduced their holdings in SCI. They're a Canadian asset manager, a very big pension provider in Canada. Look after lots of local government pension schemes. Also reduced Close Brothers and Goldman Sachs Income Builder, and they've added Allianz and Goldman Sachs Balanced. So it goes to show they don't sit in their hands. They monitor all these investment managers, and they reduce or increase their weightings accordingly. Now this is for you nerds out there, beta to equities. What beta is if the stock market drops by 1%, for example, how much would a portfolio drop in comparison? So if you're using a defensive portfolio, which is our most cautious portfolio, hardly any stocks in there, maybe one or two, but very, very little in there, all fixed income assets in there. So if the market dropped 1%, your portfolio wouldn't have dropped 1% with it. because of the amount of assets in there. It had dropped by 0.13. And as you can see, the correlation, if he was in the cautious portfolio, he'd have dropped by 1/4%. And if we go all the way up to where I am, the aggressive portfolio, if the markets drop 1%, then I drop just over 0.5%. So what have the world economies done about that? Well, all the banks. All the banks have been ploughing trillions into the market to shore up liquidity. Next slide. You will not see the words on there, but what this shows, let me pick one, the yellow. That's UK equity, so that's all the UK stocks that trade in the markets, not just the FTSE 100, all stocks. So in 2010, 1, 2, 3, 4, 5, 6, 7, 8, 9, it was 10th out of all the assets. In other words, it was the 10th worst performer. It still returned 8.76% in 2010, but emerging markets in grey returned 19% in the same year. And at the bottom, cash in purple. Good old cash, banks and building societies. Well, it's not strictly true when it comes to investing in cash because it's Forex, it's cash trading. You'd have lost 3% on cash in 2010. But look at that. Global property actually was number one. You'd have made 23% on global property that year. But the following year, gilts were top of the pops. And emerging market was minus 18 the following year. So we can go through all these charts and all these different colours, and what it's designed to show is there's no asset that managers invest in that's consistently at the top. As you can see, they're all different colours, and they would be gilts, Pacific the stocks, US stocks, Japan stocks, etc. Cash in purple has always been, I think the best cash has done is 0.39% in 2015. So if had you put your money in cash, you wouldn't have even earned inflation. So that's a very interesting slide, really, to show that you can never pick where to put your money at the beginning of the year. Okay, so the market's still ticking away. We're still up about 1%. So last thing on my agenda, you would have seen an email from me about client websites and how to do your annual review on there, which is an FCA requirement. And it's also good to check up on your investments as well. So I'm now going to show you how to do it. I've already shown you once, but I'll show you this video on how easy it is when you click onto your site to do your assessment. Takes, I think one of my clients did it in 30 seconds. You know who you are. But the average minute, 2 minutes max to complete this. So I'll show you this video.
This would have provided you with an access ID, a client ID, which would have usually been.
You can do this on app and a web version.
When you first logged in, you would have been asked to create a memorable passphrase. When you log into your client site and the review is ready to complete, you'll be presented with the following screen, which explains why completing the review is important. The review takes only a few minutes to complete. To commence the review, please click Start. The welcome page explains how the review process works and will allow you to save and complete each review for each policy. Once all policy reviews have been completed, a report will be generated which will be available to you in the Documents section of your client site and will also be made available to your advisor. Select Continue. Each policy is listed by policy number and account type. To commence each policy review, please click on the arrow at the side of the policy. As I said earlier, each review is quick and easy to complete, and you'll find that some questions are only asked once where you have multiple policies to review, as they apply to all policies, so don't need to be answered again for additional policies. Each question in the review has a response preset based on your original circumstances. You only need to change a response in any question if you feel the preset response no longer matches your current position. Once you've completed each response, you will have the option to click Save and Continue, which will save this policy review and take you back to the policy page where you should go on to click any additional policies to be reviewed, in each of which you will only be asked the first two questions. Once all reviews are complete, this will generate the report into your client site documents and be sent to your advisor. If you have made any material amendments in the review, a message will be sent via the system to your advisor, who will contact you shortly.
Thank you for watching, and we hope that you found this helpful. Please log into your client site app to complete your review. If you need any help, please contact your advisor or call the support team at head office on 0191 242 4876 and select option 1 or use live chat for instant online help.
I've heard some horror stories lately from clients, new clients I visited quite recently, where advisors won't speak to them, they hide, they switch their phone off, and these are small independent advisors. Now, I'm not saying they're all like that, but when in times like this you have to face your clients. Well, I say face them in these times, but always be on the end of the phone, the end of an email, WhatsApp, text. All of you will know I always answer my phone, always answer an email, so why wouldn't I? You know, because customers at the end of the day need reassurance, and reassurance is what I give. Not one penny has come out of any portfolio since the pandemic hit the markets, and that's good. That goes to show, without being patronising, that most, if not all, my clients were listening when we did the original meeting, and educated to know that these things don't go down and stay down, they do come back. And as I said earlier, I can't think of a better opportunity at the minute with any dead money. We had with TP, they did a bit of research because they talked to lots of companies. We are one of the very few companies, digital companies, that's got a backup system. Aviva, for example, and I've got clients with Aviva, have given a promise service level of 1 week to get back to you by email. There's no phone system. Some advisors switch their phones off as well, but you always need to speak to your clients. People who've known me for 20 odd years always know I answer the telephone, I answer any messages on social media, emails, etc. I will never hide. It's great to have all the good times and share that with everyone, but you've also got to be here as well when things are not so good. So whilst I'm working from home, I can assure you I'm always on hand. And finally, I'd just like to thank you all for sticking with it and listening to the advice. We've been here lots of times before, and it doesn't take that long to recover. So for now, until the next time, stay safe. See you all soon.